All right, so today we're doing something a little different. We're not just going to learn about investing, we're going to become financial detectives. In our guide, the one and only Benjamin Graham, the father of value investing. We're going to use his timeless wisdom to figure out how to investigate what a company is really worth, cutting right through the hype and focusing on the cold, hard facts. So, grab your magnifying glass because our investigation starts right now.
Right off the bat, this quote from Graham himself really sets the stage for us. What he's telling us is that in the world of investing, complexity is usually a huge warning sign, not a mark of genius. You know, the most powerful tools you and I have are a healthy bit of skepticism and simple math. You don't need some fancy math degree to be a smart investor. You just have to think clearly and critically.
So, what is it that we're actually doing here? We're conducting what's called a security analysis. And at its heart, this isn't about predicting the future. It's not about gazing into some crystal ball. No, it's about rolling up our sleeves and being a detective. It's about gathering hard evidence from the past and the present to figure out what something is actually worth today. It's all built on facts, not forecasts.
And this leads us to something kind of weird that Graham noticed on Wall Street. He saw this strange contradiction. The more uncertain and unpredictable a situation was, the more Wall Street analysts seemed to lean on these incredibly complex, sophisticated mathematical models. Doesn't that seem backward?
And there it is. That's the paradox in action. All that complex math is often just used to create this false sense of certainty. It's like dressing up a wild guess in a lab coat and calling it science. For Graham, when someone starts throwing around advanced equations to justify buying a stock, especially one whose value depends entirely on some distant, unknowable future, well, that's a massive red flag.
So, if we're supposed to avoid all these complicated predictions, where do we even start our investigation? Well, Graham's answer is incredibly simple. Start with safety. Before we even dream about profit, we have to build our case on solid, verifiable ground. And the best place to learn that discipline is with bonds.
Okay, check this out. This is Graham's first test of safety, and it's super concrete. He's asking a really simple question. How many times over can the company's earnings pay its interest bill? So for an industrial company, for instance, he wants to see that on average, its earnings covered that interest payment 7 times over. And even in its absolute worst year, it could still cover it 5 times. This isn't a guess about the future. It's a hard number pulled from past performance.
But a good detective never relies on just one piece of evidence, right? The earnings coverage test is just the start. Graham also demanded a minimum size for a company, simply because bigger companies tend to be more stable. He also looked for a healthy cushion of stock equity under the debt to absorb any shocks. And sometimes he even looked at tangible property value as a final backstop. It's all about building a multi-layered case for safety. And all of these different safety tests, what do they all add up to? Well, they lead us to maybe the single most important idea in Graham's entire philosophy: the margin of safety. By demanding these high standards, you're making sure there's a huge buffer between the price you pay for something and the underlying value you're actually getting. That buffer, that is what protects you from bad luck, from your own mistakes, and just from the general craziness of the business world.
Okay, so we've built our foundation on safety. Now we're ready for the main event, figuring out how to value a common stock. Now, this is a bit trickier, but once again, Graham gives us a clear, structured way to profile our subject.
And true to form, he breaks it down into 2 pretty simple steps. First, you just estimate what the company is likely to earn on average over the next few years, and you use its past performance as your main guide. Then, second, you multiply that number by a capitalization factor. That's just a fancy term for a multiplier that reflects how good and stable the business is.
And believe it or not, he even boiled it down to a beautifully simple formula to get us started. The value is the company's normal earnings times this little factor, 8.5 plus 2 times its expected growth rate, G. So think about it. For a company with 0 growth, the multiplier is just 8.5. But for a company growing at, say, 7% a year, that multiplier jumps up to 22.5. It's a really powerful shortcut.
But hey, that formula, it's just a starting point. A true financial detective has to dig deeper and look for other clues. You've got to ask the tough questions. What are the company's real long-term prospects? Is the management team any good, and are they working for shareholders? How strong is the balance sheet? And hey, does it have a long, steady record of paying dividends? All these things help you decide if that company deserves a higher or lower multiplier.
All right, now we get to the most critical part of our whole investigation. That earnings number, the one that all these valuations depend on, it can be a total house of mirrors. This is where a good detective can spot the deception that everyone else misses.
Let's pull up a classic case file from Graham himself. Back in 1970, the aluminum company Alcoa reported its earnings. Simple enough, right? But which earnings are we talking about? Depending on how you sliced it, before or after special charges, or on a fully diluted basis, this one company had 4 different earnings per share numbers. The highest was $5.20, the lowest was $4.19. That's a 24% difference for the exact same year's performance. How is that possible?
And listen, this isn't some dusty old problem from the 70s. As this more modern commentary on Graham's work puts it so bluntly, the potential for deception with accounting is just enormous. In fact, modern accounting has found even more creative ways to hide the truth. Let's look at a few of the big ones.
First up, we've got pro forma, or what I like to call as-if earnings. This is where companies show you what their profits would have been as if a bunch of bad stuff just didn't happen. They just ignore real cash expenses like merger costs or taxes. It's like owning a sundial that only counts the sunny hours. I mean, it tells a nice story, but it's not the whole truth, is it?
Next, you've got these little tricks we could call capital offenses. This is an accounting sleight of hand, where a company takes a normal, everyday business expense, and instead of subtracting it from revenue this year, they call it a capital asset. This lets them spread the cost out over many years. It magically makes today's profits look way higher than they really are. This was a classic trick used by companies like Global Crossing right before they went bust.
And here's a third one that's really subtle: the pension dimension. If a company assumes its pension fund is going to earn a really high rate of return in the future, it can contribute less cash to that fund today. And that reduction in spending, it flows straight to the bottom line, creating these phantom profits that have absolutely nothing to do with how the actual business is performing. It's profit from a spreadsheet, not from operations.
Okay, I know all these tricks can make it seem overwhelming, but remember, Graham's whole method is about giving us a clear path through the confusion. So how can you actually apply these lessons and avoid the traps? Let's put it all together into a practical checklist you can use for your own investigations.
Here are 3 simple but really powerful rules for your detective kit. 1. Read a company's annual report backwards. Seriously. The good stuff, the important details, they're often buried in the back. 2. Always read the footnotes, especially the one that describes their accounting policies. That's where companies have to tell you about their tricks. And 3. Don't get hung up on a single year's earnings. Average them out over 7 to 10 years. That gives you a much truer picture of a company's real earning power and smooths out any of these accounting games.
You know, when you boil it all down, every tool, every technique, every single thing we've talked about today comes down to this one simple question. Are you focused on the price, or are you focused on the value? A speculator focuses on the price, just hoping and praying it goes up. A financial detective, an intelligent investor, focuses on value, calculating what a business is truly worth and then buying it only when there's a significant margin of safety. The choice is yours. Which one are you going to be?